Great. What I'm going to do instead is sort of a thought exercise to essentially question and stress test some of the assumptions behind the big strategy to push Saudi Arabia into a post-oil age. So what I do is just to think through systematically what it would actually mean for the Saudi economy to be post-oil. And the main points that I'm going to go through in the next 40 minutes is that, first of all, I'll just recap what I think most of us know, is that even after all the reforms that have happened in the last few years, which in parts have been very impressive and have happened at an unprecedented pace, Saudi Arabia does remain essentially a distributive state. So a state in which economic activity depends on state spending, and state spending is largely financed through oil income. And that's a structural fact that's not going to go away anytime soon. And the main tool of distribution into the wider economy is state employment. And that remains as important now as it has been 3 or 4 years ago. The private economy, the private sector, remains deeply state-dependent. It remains dependent on protection and financing from the state, which is another structural fact that won't go away very quickly. And if we believe in that long-term objective to move into a post-oil economy, the path is going to be very long. It's going to be a multi-generational path rather than a path of 12 or 13 years. And I think, in many ways, decision makers and policy makers have realized that in the last few years, and that there have been a lot of adjustments to the policy. But I think what I hopefully can bring to the table is a systematic thinking of what would be the post-oil benchmark and how large exactly is the distance to that. So I'll specifically look at 2 dimensions of what it would take to be post-oil. One is the fiscal capacity of the state. So what would it take to have a private sector that's large enough to function as a tax base for the government? So if we really want to become independent of oil income, how large would private economic activity have to be so that we can tax it sufficiently to finance government operations that way? And the second question is, what would the labor market have to look like to be the type of labor market that we have in a non-oil economy, which is essentially a labor market in which most employment of citizens as well as foreigners is in the private sector rather than the public sector. So it's those 2 benchmarks. What would the kingdom have to look like to be able to finance the state through taxation and to maintain employment mostly through private firms rather than government? And then the very brief conclusion, to the extent that I'm going to say anything about policy, is that in the midterm, for the next 10, 20 years, and probably even beyond, obviously the challenge is to become as post-oil as possible and to move away from oil dependence as much as possible. But at the same time, it's as important to make the current system based on distribution of oil revenues more efficient, because that is going to remain the fundamental name of the game for at least another few decades. So it's not about becoming Singapore, as it were, at least not in the midterm future. It's more about becoming Norway or Canada. So a resource-rich state that's run efficiently and that's got a non-oil economy that's built around the resource sector and a government that's still largely financed through resources. So just a few quick reminders about how omnipresent the state is in the Saudi economy. Here's a first graph that some of you might have seen before in a paper of mine, where I show the share of government employees in total employment among citizens in Saudi Arabia and in a number of other benchmark countries. So just across a fairly random selection of emerging markets and more advanced economies. And you see that consistently over time, and if we extended that to 2017 or 18, the picture would look exactly the same. In Saudi Arabia, about 2/3 of citizens who have a job are employed by government in the public sector. And that's an extremely, extremely high share. There's only a handful of countries where that share is higher, and that is Kuwait, Qatar, the United Arab Emirates, and Brunei. Those are the only 4 countries that have higher shares of government employment than Saudi Arabia. In non-oil economies, or economies with a smaller oil sector like Malaysia, Indonesia, the share of public in total employment is less than 20%. It's sometimes less than 10%. So in Saudi Arabia, the dependency of the population on government jobs is orders of magnitude higher than in other economies. And it's really in a class of its own, together with the other Gulf countries and a very small number of oil countries in other regions. And it is really the key tool historically of wealth sharing. And I've written somewhere else about the historical reasons for why the Saudi state has built this large apparatus to distribute the wealth among the population, mostly through government employment, also through other schemes, subsidies and housing schemes, but the key channel is government employment. And it's not a matter of course. It's not that if you have oil, you automatically become generous. There are countries that are quite oil rich, particularly in sub-Saharan Africa, places like Gabon or Equatorial Guinea, that are very oil rich per capita, but where the money isn't shared at all. There's very, very high levels of corruption, very high levels of theft, a very small state, and a kleptocratic elite of a handful of people who essentially grab all the rents. So the fact that in the Gulf oil monarchies, wealth is widely shared through government employment is actually something relatively unique. It's not something that we necessarily have in other oil countries. And I've written papers about why I think leaderships and governments here have been so relatively generous. For our purposes today, I just point out that arguably there's significant overemployment in all those governments. So they employ more citizens than they would need to function because of the political rationale, because of the social contract of providing essentially a job guarantee, at least for male citizens. Now, it's not an ironclad guarantee, and the waiting times have become longer, but the kind of default trajectory of job seekers is to wait for a government job to sooner or later materialize, particularly for males. It's harder for females to get public sector jobs. So public sector job creation has slowed down significantly since 2015 in the new reform era for fiscal reasons and because the government wants to push Saudis into the private sector and make them find jobs and be entrepreneurial there. But that's only kind of nibbled at the edge of those numbers. Fundamentally, it's still 2/3 of Saudis who remain employed by government, and the expenditure on that kind of employment as a share of the total budget is higher than almost anywhere else in the world. So it's currently around 45% of total government expenditure. Typically, government spending on salaries is 20 to 30% in the rest of the world. So a huge wealth-sharing apparatus that's been built around public employment. And we've seen a lot of radical economic adjustment the last few years. And a lot of it has affected economic elites quite heavily. So the corruption crackdown, the slashing of capital expenditure by the government, the delayed and contested contractor payments. So the government has come down pretty heavily in parts on a business class that has been seen in parts as rent-seeking or inefficient. At the same time, the leadership has been fairly reluctant actually to touch households, to take away distributional entitlements from regular Saudi citizen households. And in fact, the total spending on public sector salaries has gone up at a pretty fast pace. So it's gone up in 2017 from 409 billion SAR the year before to 440. This year, if we extrapolate the fiscal figures from recent Ministry of Finance reports, it'll reach 470 billion SAR. And that's more than the total budget was just a decade ago, just to give you a sense of the orders of magnitude. And while there have been some fiscal measures that have affected households, so energy price increases, the introduction of a value-added tax, also indirectly the expat levy, because that has affected price levels to some extent. Some of that has been passed on through retail prices. At the same time, the government has been very careful to compensate households for that through increases in public sector salaries temporarily, through the citizens' allowance. So while economic elites in the private sector have been hit pretty hard in the short run by economic adjustment, households have been protected much more, and I think there are both structural and political reasons for that. It's one of the few areas where the government has kind of scaled down its ambitions. So when there was an attempt to cut public sector allowances, that was reversed after a few months. It was very unpopular, and then the allowances were retroactively reinstated. So to the extent that the Saudi state is sort of a wealth distribution machine, that kind of core machinery remains intact through public employment and by now other social transfers. So it very much continues to be a distributive state. If anything, the scale of distribution has gone up further, and it has proved very difficult to rescind those types of distributional obligations, even when it was tried. It's very hard to take away employment or transfers from Saudi households. And the same was actually true in the 1980s and the 1990s. When oil prices went down, the government first of all cut spending that benefited the big business families, that benefited contractors, that benefited the private sector. So when capital spending was reduced to almost zero in the late 1980s, hundreds of thousands of contracting and construction companies went belly up. The private sector really suffered. At the same time, government employment increased every year. Throughout almost 20 years of deficits in the 80s and 90s, spending on households continued to grow. So that, I think, gives you a sense of political priorities and the difficulty of touching those popular entitlements. So the core distributional arrangement remains intact, at least for the broad population. At the same time, business has suffered through the adjustment, at least temporarily, but it remains very state-dependent. So if you plot here the total size of state spending every year against the total size of private sector GDP, so the total annual economic activity of the private sector, the two are very closely correlated. So if the state spends more, the private sector grows. If the state spends less, government quasi-fiscal operations, subsidies, so state fiscal operations have a very strong impact on what the private sector does. If the state spends less, the private sector tanks, and that's what we've seen in the last few years. Now it's being reversed because oil prices are up again and the government can afford to spend more in 2018 and 2019. So we'll see some growth, but the basic driver of that will remain fiscal. It will remain state spending. So both households and the private sector are deeply dependent on state spending through various channels. There's another indicator here that illustrates that. It's the ratio of government to private consumption in Saudi Arabia compared to other countries. And what it shows, in short, is that relative to private consumption, government consumption is much more important in Saudi Arabia compared to other countries. So when the government stops consuming, it'll have a stronger impact on GDP than it does in other countries. Interesting line here about the UAE. I think a lot of quasi-government consumption by state entities probably isn't included in that line, because if you think of the economy of Abu Dhabi, it is actually almost as driven by state spending and quasi-state activity as the Saudi economy. But in other economies, government consumption is a lot less important relative to private consumption. Now, what happens, of course, when government spending plateaus, when it slows down or when it is reversed, is that government job creation also tends to slow down, right? Because most of, or almost half of government spending goes into employment, into salaries and transfers. But at that moment, the stimulus to the private sector also decreases. But this is the very moment when you would need the private sector to pick up the slack and to generate jobs. So you're in a bit of a bind that the private sector is under pressure and is not able to create jobs in exactly the moment when the government also stops creating jobs. And you see that in that kind of projection that would look very similar if I extended it into 2018. So the gray line is how many private sector jobs for Saudi citizens would be needed just to keep unemployment constant, just to absorb the additional net entrance to working age. And the orange line and the blue line is the actual number of jobs that were created in the private sector. And of course, with the fiscal slowdown from 2015 and the necessary fiscal adjustment, private sector job creation also slowed down. It had to, because there was just less money in the economy. And the fiscal adjustment was absolutely necessary given the oil price environment. But it triggered a situation where the private sector couldn't step into the breach and couldn't compensate for the fact that the government essentially stopped hiring new Saudis in 2015. Now, I won't walk through the details of that. I'll just tell you that this is the result of a very simple modeling exercise where I looked at the original figures in the fiscal balance program, so the midterm fiscal adjustment, government spending adjustment program that came out in December 2016. And I just used fiscal multipliers from IMF literature and other sources to see what the impact of non-oil GDP would be if the fiscal balance program had really been implemented as it was planned. And it shows you that if spending had really been cut as planned, and if energy price reforms and taxes had been introduced at the originally intended pace, you would have had a very severe contractionary effect. So the government would have taken a lot of money out of the economy, and the private sector would probably have shrunk, which is just logical if you think of the mechanisms of fiscal multipliers in Saudi Arabia. Because it became visible, I think, that this would be the case. The fiscal balance program was adjusted. The balanced budget target was pushed out to 2023 very reasonably. And now I think it might be pushed out even beyond 2023. Even the adjustment to the fiscal balance program from December 2017 now has been adjusted again in the pre-budget statement that just came out that promises even more government spending and slower revenue side measures, so slower introduction of additional taxes and energy reforms. No, which, given higher oil prices, is completely reasonable. But it also shows, I think, a realization that if you adjust your fiscal policies very quickly, it'll hit the private sector and the non-oil economy very, very deeply, as was temporarily the case in 2016. So that's just by way of background to hopefully convince you that economic activity is very strongly driven by the state in Saudi Arabia. Now, now for my little thought experiment, for what would the Saudi private sector have to look like to sustain a non-oil, a non-rentier economy? And as mentioned, I've got two yardsticks for that thought experiment. First, I use OECD economies as benchmarks, so just the most advanced economies in the world. And then I ask, which tax burden would the private sector have to bear to maintain current levels of state spending? So to maintain the current level of state services, how many taxes would the private sector have to pay, and how large would it have to be able to pay those taxes? And then secondly, how many jobs would the private sector have to provide to make the Saudi labor market be similar to that of an advanced economy in terms of the public-private split? And then I just use various benchmarks from the OECD for the tax to GDP ratio and try to apply that to the Saudi scenario. And the point is not to predict what's going to happen in Saudi Arabia. It's also not to say that this is where Saudi Arabia should be. It's just a thought experiment to show where it would have to be if we take the idea seriously for it to become a non-oil economy, a non-rentier economy. And the underlying point is really that this is a very long-term ambition. It's as important to make the existing oil-dependent economy more efficient because it'll take generations to really move beyond oil. And I think it's something that's becoming clearer also in official statements. Okay, so what about the tax burden? How large would private business have to be, or private sector GDP have to be, to provide enough taxes for the current government spending? So the recurrent non-oil revenue in 2017 was 97 billion Saudi riyals. So that's essentially taxes and fees that are levied every year. It's not one-off income from privatization or investment returns. It's recurrent taxes and fees. It's likely to be quite a bit higher in 2018 because of VAT, sin taxes, and various other measures that have, and the expat levy that's been introduced. So it's likely to reach 170 billion Saudi riyals in 2018. Total government spending in 2017 was more than 9 times more than the tax income. So it was 926 billion Saudi riyals. And according to recent pre-budget figures, total spending is likely to reach a bit more than 1 trillion Saudi riyals in 2018. So that'll still be more than 5 times more than the tax income that we expect in 2018. So if we just assume that we want a balanced budget in the long run and we don't have any oil revenue, financing the government would require additional taxes of 826 billion Saudi riyals. So we don't necessarily need a balanced budget. We might run a small deficit, but at a sustainable deficit level of 3 or 4%, we'd still need at least 700 or so billion Saudi riyals of tax income. Again, it's not a realistic scenario, it's just a theoretical benchmark to make my point. So if we think that we want a non-oil economy that's financed through taxes on private economic activity, how large does the private sector have to be able to pay these kinds of taxes? And here is just a benchmark of tax to GDP ratios across the OECD. So in the country with the lowest taxes, Ireland, you've got, I think, 23% of GDP paid by way of taxes. The country with the highest tax to GDP ratio in the OECD is Denmark, and that's, I think, 46%. Sweden's not far behind, I believe. And the black line is just the OECD average, which is about 35%. So about a third of total economic activity is generated by way of taxes. So here's the most complicated and involved table in the presentation. Here I've calculated how large the private sector would need to be able to finance government operations through taxes at the OECD average tax level, at the Irish taxation level, which is the lowest in the OECD, and at Danish tax levels, which are the highest. So those are just more or less arbitrary benchmarks of advanced countries of the kind of type that the Saudi economy arguably aspires to. And the total size of the private sector, if you want to reach the OECD average taxation ratio, would be more than 2 trillion Saudi riyals, 2.1 trillion Saudi riyals. That's almost twice as much as the current size of the Saudi private sector. So you'd need a huge amount of economic growth for your private sector to be large enough to sustain enough taxes to finance the government. If you're on Irish tax level, so at the lower end of the advanced country spectrum, then the Saudi economy would have to be 2.5 times as large, or the private sector would have to be 2.5 times as large as it is now. So it would have to be more than 3 trillion, 3.1 trillion Saudi riyals large. And if you're a pretty harsh economic decision maker and you say, I'm going to impose 45% taxes, which is a very high rate, so that would be the Danish rate, the private sector still would have to be a third larger than it is now. So at current levels of private economic activity, the government actually can't be financed through taxes. The economy just isn't large enough to generate enough taxes, so there have to be other sources of income. And I've mapped out here how long it would take for the private sector to grow at different growth rates to be large enough to maintain those different tax levels. If it grows at 3% in real terms, compound annual growth rate, then it would take 18 years to be large enough to reach the OECD average in terms of taxation capacity. For the Irish level, the private sector would have to grow for 32 years at a compound annual growth rate of 3%, which is very high for a high-income economy like Saudi Arabia. For the Danish scenario, it's only 9. I don't think politically it's realistic to ramp up taxation to 45% of GDP in the Saudi context. Then the rest of the table, I'm happy to share the slides after the presentation, shows that if you look at the share of total taxes, not in all of GDP, but just in private sector GDP, so it's just the share of private sector economic activity that gets taxed, then things look even worse. So then in the Danish example, companies would have to pay 60% taxes almost. Even in the Irish example, they would have to pay 30% taxes. And because taxes partially get passed on to consumers. So if the government taxes a company, some of the cost will be reflected in consumer prices. Companies will try to recoup some of that cost. If we assume that half of the costs through the new taxes get passed on through higher prices, we'd have inflation levels between 13% and 26%. So we'd have a very significant cost push. If we assume that the private sector is mean and monopolistic and they can pass on all the extra costs to consumers. So they don't bear any of the taxes, they just make their products that much more expensive that effectively consumers pay all of the cost, then we'd have up to 50% inflation. The current tax to GDP ratio in Saudi Arabia for 2018 is about 6%. So that gives you kind of the current benchmark. So even to get to the Irish level of taxation, you'd have to increase taxes by 17 percentage points. And one problem with theoretically increasing taxes to high levels is that, as we saw before, taxes actually have a strong contractionary impact. If you tax the private sector heavily, it starts to shrink because its costs go up. And that's the case in any country in the world. So you're in a bind where, at the one hand, you need a much larger private sector to be able to actually levy sufficient taxes. But if you start taxing, it's going to have a contractionary impact. It's going to make the private sector tend to shrink, especially if you start from a low level like 6% and then go to a much, much higher level in the 20s or 30s. So some preliminary insights from that are that at current levels of private sector activity, at the current size of the private sector, government expenditure can't be realistically financed through taxes. You would have to tax the private sector to death. You'd have to have taxation rates of 70% and more, especially considering that a realistic taxation level in Saudi Arabia would probably be closer to the Irish scenario rather than the Danish scenario because of the cost impact and the impact on business closure and competitiveness. You would need very substantial private sector growth to be able to finance the government through taxes. And I talk about the private sector because, in effect, that's always the source of taxation. I mean, the government could tax itself, but that wouldn't create any net revenue. So realistically, all taxes have to come from private economic activity. But there is a trade-off between raising non-oil revenue, so raising taxes, and private sector growth. The more you tax, the more you hit growth. It's just natural. And if you assume a fiscal multiplier of 0.5, which is pretty low, so that's close to some of the IMF estimates, if you raise taxes by 800 billion Saudi riyals, thereby being able to finance the government completely through taxes, you would shave more than 400 billion Saudi riyals off GDP. So the private sector would shrink by almost a third. So that would be like almost genocidal exit of firms and shrinkage of private economic activity. So it's really, in the short run, not feasible. The whole tax and revenue generation agenda is very worthwhile, and it's very useful that there is a VAT, that there are taxes on foreign workers, but in the short to medium term, these kinds of taxes can't be ramped up to a level that can realistically replace oil income. So what you need is very, very rapid growth in productivity, labor productivity, total factor productivity, so that the private sector can grow fast enough to maintain some tax bases. But historically, if you look at the lines of Saudi Arabia and also the UAE here, labor productivity has actually been flat since the 1980s. The main reason for that being that labor costs are very low because foreign workers can be imported almost without limit. And the incentive specifically is to import low-skilled workers. And with low-skilled workers, it's very difficult to push up productivity. So that line here would have to go up like this if realistically the private sector was to grow to the levels that we discussed here. Okay, so that's the private sector. It's now a few quick slides on the labor market. So how would the private labor market in Saudi Arabia have to look like if we imagine Saudi Arabia to be like an advanced economy, so to have a labor market with a similar split between public and private jobs? So here, by way of benchmark, are the public sector employment shares in different OECD countries. So the country with the highest share of government employment in total employment is Denmark. So that's 35%, just followed by Sweden here, also very high government employment. And then the Koreans, almost no one works in government for some reason. So almost everyone works in the private sector. The average is around 20%. So around 20% of people in advanced economies work in government, 80% work in the private sector. Now the Saudi ratio is about 65%. So it's roughly, if you start here, it would be roughly up here, right? That's where the Saudi public employment ratio would be. So if we imagine that a future post-oil economy would largely be driven by private economic activity and most jobs would be provided by the private sector, as in any advanced economy, then this ratio would have to come down very drastically. So the government would have to shrink drastically in terms of employment, and the private sector would have to create many, many more jobs for Saudis. It already creates many jobs for expatriates, but the challenge is job creation for Saudis. So here's the first scenario. So if we keep the participation ratio constant, so that the share of Saudis who are actually active on the labor market, and then we imagine a recalibration in line with the OECD proportions, then we would have to more than double the number of private sector employees among Saudi citizens, so from 1.9 million to more than 4.1 million, and the public sector would have to shrink by about 2/3. Then this distribution would make the current Saudi labor market sort of like the average OECD labor market. So a massively smaller share of government employment and a much larger contribution of private employment for Saudi citizens. So a change rate of 120% and minus 67% here. Of course, that's assuming constant participation rates. But what we can expect in the future is that participation rates are going to go up because particularly women are going to join the labor force. So that's really a lower boundary estimate. So if we want to reach those 4.1 million Saudi employees in the private sector at a 5% compound annual growth rate, it would take 16 years to reach that. And that would be a very fast employment growth rate. Almost no country has achieved employment growth at that pace. At a 3% compound annual growth rate, it would take 27 years to get here in the private sector. At the same time, the Saudi workforce continues to grow for demographic reasons. So the new cohorts reaching working age are larger, much larger than the cohorts that get pensioned off. So the total number of workers increases. So in 16 or 27 years, you'll actually need a much larger total because the population will be larger. So that's a tough nut to crack, right? First of all, imagining shrinking the government by 2/3, very politically difficult, and then more than doubling private sector jobs, also very difficult, and that's assuming constant participation. Now, if we aspire to participation rates like in the OECD, so in other words, if we assume that in the future Saudi citizens will be participating in the private labor market at the same, in the total labor market at the same rate as in advanced economies, then the scenario will become even more dramatic. So participation just means the share of people in working age who are actually active on the labor market. Participation in Saudi Arabia is very low because the majority of women still abstain from the labor market, and men join the labor market relatively late and reach pension age relatively early. So the current participation ratio in Saudi Arabia is about 40%. So 40% of Saudis in working age are actually active on the labor market. So 60% are inactive. They're homemakers, they're retired, or they just stay home. And the employment ratio, so the share in working age of those who actually have a job, is 35%. So the difference between the two is just unemployed. So people who are on the labor market but haven't found a job. So the OECD average employment ratio is 68%. It's pretty much twice as much. So people in working age in the OECD are about twice as likely to have a job than in Saudi Arabia. There's a very strong gender component to that. A lot of that is explained with the low female employment ratio in Saudi Arabia, but not all of it. Male employment is also somewhat lower than in the benchmark countries. So here's the OECD average, 68%. What's this here? Is it Ireland? No, Iceland? It's Iceland. So everyone works in Iceland for some reason. Yeah. No, there's no homemakers. All families have two earners. Everyone has a job. And here there's South Africa, which is close to the Saudi ratio. So you have a very low participation ratio. So a lot of people are out of the labor force, although they're in working age. Okay, so if we assume that we want A, as before, the private sector to assume the majority of job creation, as in the OECD, but we also want an OECD-style employment ratio. So we want Saudis to be employed with the same probability, to be as active on the labor market as in the OECD. Then we would have to increase private employment in Saudi Arabia from the current 1.9 million to 8 million. So it's an increase, it's a fourfold, more than fourfold increase. So that's something that, even again at a 5% compound annual growth rate would take 30 years, at a 3% growth rate would take 49 years, and that again is not even accounting for the fact that there's going to be population growth. So for probably a generation or so, having an OECD-style labor market is not realistic. So the kingdom can and should move in that direction, but it's a very long-term ambition because the private sector would have to be essentially 4 times as large to create that many jobs. Now, that all might sound dispiriting, it might sound depressing if we think that by 2030 Saudi Arabia should really be a non-oil economy. It should be completely independent of hydrocarbons. But I think that's the wrong way of framing the debate. I think Saudi Arabia will remain very strongly impacted fiscally and in terms of the business cycle by hydrocarbons and by state spending for many decades to come. But I don't think that's necessarily terrible news, at least as long as we don't assume that there's going to be peak demand for oil and prices will drop off very soon. And I think the scenario that I outlined here is theoretical. It's not something that we should aspire to anytime soon. It's just a theoretical benchmark that shows you that non-oil economics is a very, very, very long-term ambition. I think in the short run, it's probably more important to make the existing economy that is dependent to an important extent on oil and state employment more efficient. So that's the point that I made at the beginning. It's probably more realistic to aspire to be like Norway or like Canada rather than like Singapore. Norway and Canada are countries that have large resource sectors, which in the case of Norway are fiscally also dependent on oil, where a lot of state income comes from that sector. But the service economy that's been built around those sectors and that serves households and the government is more productive and is more efficient than in other oil economies. So I think, just very quickly, last slide, some of the key challenges against that background are first, to make public sector employment more productive and more efficient, because for the time being, that's where the majority of nationals work. And this is not going to change anytime soon. It's unrealistic that millions of people will be fired, will be let go from the public sector. It's not realistic that the private sector will add millions of jobs very quickly. So what do we do with that stock of employees? I think it's very important to make the public sector itself more efficient because it's so important in the economy. We can talk about how that could be done. And we should focus on improving the efficiency, the quality, and the productivity of the service economy that surrounds households and government. Of course, there's the conventional diversification strategies in industry, in non-oil exports. All that is useful and important. But I think the service economy that serves households and government is larger in absolute terms, and making it more productive and more efficient is at least as important as trying to diversify into non-oil production and industries. In the long run, the government will not be able to accommodate job seekers because of fiscal constraints and because of a growing labor force. So it is very important that there is a shift towards private employment for citizens that happens gradually. So that is inevitable. It won't completely replace government employment. It won't lead to a ratio of public to private as in the OECD. But the direction of travel, I think, should be clear. And policies that allow a transition away from public to private sector employment, even if we don't get to an OECD-style split for generations, is absolutely essential. And I've done more work, including the paper that's just come out with the center about how this private sector Saudization could be done. So I think that's an absolute priority area. And finally, I should say that the basic maths, the numbers, and the challenges are very similar for other OECD countries. So the story is very similar in Bahrain, Oman, in the UAE, in Qatar, in Kuwait. So there's an opportunity to learn from each other and to exchange knowledge and to think creatively in a kind of regional space about those challenges. And I think I went over time. I didn't look at the clock. I apologize.